Welcome back to Street Smart. Late this morning, Fed policymakers began a two-day meeting to decide what the central bank should do next to keep the economy from stalling. Joining us now with his outlook for the meeting is Ward McCarthy. He's chief financial economist at Jefferies Co, one of the 20 primary dealers that trade directly with the Fed, and a former economist at the Richmond Fed Bank. Thanks so much for joining us, Ward. Let's talk about the two-day meeting here. It wasn't supposed to be a two-day meeting, but Ben Bernanke wanted, do you think, time to convince the hawkish members of the committee that maybe we do need some more action here?
Well, I think he wanted to have time to air differences, and I think he also wanted to present his case for why he thinks the Fed needs to take more action at this point in time. He set the stage for it really back in June, and I think he sort of kept the momentum going in Jackson Hole, and now it's time for the Fed to act.
And is there more reason now than there was then for the Fed to actually do something? Beyond,
well, I think so.
Change the language or keep a guarantee of interest rates at a low?
Well, I think so. We've seen the economy soften up again, primarily because of the consequences of the budget negotiations and the debt downgrade that fell from that. It was a consequence of that, and confidence fell, quite precipitously. So I think he feels like the burden is on the Fed's shoulders. We're not going to get any help from the fiscal side, so the Fed has to keep doing what they can.
What do you think about QE2? I was listening to former Richmond Fed President Al Broadus today talk about it. There's a debate. Was it successful? Was it not? He thinks yes, because we didn't have deflation. Others would say no, because it just put bubbles into commodities markets.
Well, I think it was successful in that it did. We were in a deflationary environment, and it reversed that. And the deflation is the central bank's biggest nightmare. So I think it was successful on that front. Where it has not been successful is that QE2 has not filtered into the real sector of the economy. And for example, the Fed's balance sheet went up by about $1.6 trillion. Bank excess reserves went up by about $1.6 trillion. And that has not gone into the real sector of the economy yet. So it was partially successful, in my opinion.
How can they get that money into the real sector of the economy? How can they achieve basically the second goal that the Fed has, which is to boost employment, or at least to keep it at a level 5% or 6%?
Well, it's going to take time. And what they will do is to try to provide stimulus in whatever way they can. I think what they'll do tomorrow is change the structure of their holdings so that they can encourage lower 10-year and 30-year rates. And on the margin, that should help. Sometime in 2013, if we haven't seen a significant improvement in the economy, then they'll probably go to a QE3. So they don't have a whole lot of tools. All they can do is buy time, try to make the financial markets be as comfortable with the economic environment as possible, and try to foster growth that way.
Why does it help to have lower 10 and 30-year yields? I mean, especially considering that we're in a period of deleveraging, so businesses aren't taking on loans. Banks are being sued and not giving out loans, right? They need to worry about boosting capital. And the housing market, which has been obviously the huge problem in this recovery, is going to have trouble recovering when people are worried about having a job, right?
Well, I think what the immediate reaction they're hoping is that by getting rates lower, you'll have some more consumers who are able to refinance their mortgages, and that some businesses will be able to borrow at lower rates. I think probably a secondary objective is that they're thinking is if they can get riskless returns down as low as possible, then that will encourage investors to move into more risky assets and provide some stimulus to the economy that way.
Which, by the way, brings me to the point that money markets have been making. If you get rid of the interest that the Fed is now paying on reserves, it makes it harder for money markets to not to break the buck, right? Am I splitting my infinitive there?
That's exactly right.
In any case, you get my point. It's going to be difficult. Do you expect that to happen tomorrow?
Well, frankly, I'm hoping they don't lower the rate they pay for excess reserves, but I think they could lower it by maybe 10 basis points. It really is a two-edged sword. To the extent it lowers short-term rates, it really isn't going to have much of an effect, but it would increase the risk of money market funds breaking the buck, and of course that could have secondary effects throughout the financial markets that they really want to avoid.
We're at a point, by the way, which Al was talking about today. Fed policy has gone where no Fed policy has ever gone before, right? I mean, it's historical.
This is all experimental. We can't go back to prior cycles and say, oh, the Fed did this in whatever period when they were easing. In fact, in some respects, it goes beyond that because they're trying to flatten the yield curve at a point in the business cycle when they're typically contributing to a steepening of the yield curve. So up is down these days.
Got it. All right, Ward, thanks so much for joining us. Ward McCarthy there, Chief Financial Economist, Jefferies and Company.